All right, the FIFO method. Again, we stopped here. So let's revisit the FIFO method one more time. The FIFO says first in, first out. So the oldest inventory will go out to customers and go to the cost of goods sold first. And the newest or the last come-ins will be stayed left behind as the ending inventory. Again, this is just an assumption. We're assuming that's the flow of the inventory. So if we plug in the numbers and go back to the scenario one more time, the oldest is this batch from the beginning inventory, and we made two purchases in sequence, $30, $8 each, $10, $10 each. So if we look at the ending inventory, because the newest will be stayed in the ending inventory, and we know that it's not showed on the slides here, but we have to be able to calculate the total available in terms of units is 10 plus 30 plus 10 is 50, and we sold 15 units, so 35 units, so the ending inventory will be 15. That's 50 minus 35 equals 15. So we want to find out what's the cost of those 15 units. They must from the newest. So the newest one is this patch, that 10 units at $10 each. So 10 units at $10 each. We're looking for 15. We already find 10, so we need another 5. Another 5 will come from the second newest patch, which is this one, 30 at 8. Well, that's good enough because we're looking for 5. This one has 30. So that's 5 at 8 each. That's how we get 140. For the cost of goods sold, we can do it two ways. First, we can use 410 minus 140 equals 270, or use the definition of FIFO, which means the 35 units that's sold and included in the CGS must come from the oldest units. So the very oldest one is this 10 units at $7 each. So we take those 10. We need another 25. Another 25 must come from the second oldest. So 25 times 8, and then 70 plus 200 equals 270. So let's look at LIFO. Again, here you can try pause the video for a second and try to figure out on your own. The layout is the same. One patch of beginning inventory and two purchases. So this is the newest. This is oldest, sorry, in terms of time. And then this is the newest. Total goods available for sale is $410 and 50 units. If you look at the ending inventory, the LIFO says last in, first out. So the ending inventory must come from the oldest, right? And again, we're looking for 15 units. The very oldest one in the beginning inventory is 10 units at 7. So we take those, 10 times 7. We're looking for 15. We already have 10, so we need another 5. That's where the 5 come from. 5 come from 15 in an ending units minus 10, which is the beginning inventory, which is also the oldest in this question. So 5 come from here at 8 each. So 10 times 7, 5 times 8 equals 110. Again, your cost of goods sold can be calculated either by using 410 minus 110 equals 300, or use the definition of LIFO. LIFO says last in, first out. So what goes into the cost of goods sold? The newest ones. 10 each at $10, 10 units and $10 each, that's $100. We're looking for 35 units being sold. We already found how many? 10 in the newest. So we have to go to the second newest, which is this patch, which total in this total is 30 units at 8, but we only need 25. Again, where does the 25 come from? 35 units sold minus 10 from the newest patch. 25 at $8 each, that's how we get 300. All right, so the last method, the weighted average method, the idea here is we're going to use the total units of available inventory, which is 10 plus 30 plus 10 equals 50. We also have to calculate the total cost of the units that's totally available. 70 plus 240 plus 100 is 410. So we divide 410 by 50. Thus we get the weighted average cost per unit for all the units. So cost of goods sold available, the cost of goods available for sale divided by the number of units available for sale, we get $8.20 per unit. And then we can go back to this scale or table because we know the number of units in the ending inventory, right? That's 15 times $8.20 each. That's $123. We also know how many units in the CGS because we sold 35 units, so that's cost of goods sold has 35 units times the same unit price or cost, which is $8.20, we get 287. Or alternatively, again, you can use the total goods available for sale, $410 minus the ending inventory, which is $123, we get the same $287. Alright, so that's the three methods. We can compare them quickly. We just plug the numbers from the previous calculations into this side-by-side comparison table. We have LIFO, we have FIFO, LIFO, and weighted average. The total sales is the same, right? Because that's the price we sold those units, 35 of them, to our customers, which is the same across the board. We calculated the cost of goods sold differently. So the FIFO is the lowest, the LIFO is the highest, the weighted average is in between. And I want to ask you, why is that the case? And then alternatively, under the FIFO, the value of the ending inventory is the highest. The value of the LIFO inventory is the lowest, and then the weighted average is in between. So I want to ask you, why is this the case? If you want to think it for a second or pause the video to think about it, that'll be perfectly fine. So basically, because if we go back, the unit price was increasing, right? For the three patches, for the 10, 30, and 10 units, three groups, the unit price went up from 7 to 8 and then to $10. So under the FIFO, the first in, first out, which means under the FIFO method, most of units are coming from the oldest ones when the unit price was lower. As a result, the cost of goods sold was the smallest among the three. And then because the price was going up, though the LIFO was the highest, and then the weighted average was in between. Alternatively, if we look at the ending inventory, the cost of ending inventory, because the unit price was constantly going up, and under the FIFO assumption, remember the ending inventory come from the newest or the most recent purchases. For the same units, the unit price in the recent patch is higher than the unit price in the oldest or in the older patch. As a result, the ending inventory for FIFO is the highest, for the LIFO is the smallest, lowest, and then the weighted average is in between. Okay. And another thing I want to mention here is because of the difference in the cost of goods sold, or cost of CGS, the net income or the income before tax income was different. FIFO is highest, LIFO is lowest. As a result, for the same tax rate for the current period, FIFO has the highest tax expense. LIFO has the lowest tax expense. As a result, net income is highest under FIFO and lowest under LIFO. So the tax consequences, even if it's temporarily, is the most important consideration for one of the most important consideration for using FIFO versus LIFO. Of course, under the U.S. accounting principles, that's the GAAP, generally accepted accounting principle, both LIFO and FIFO are accepted. But under the international standard, IFRS, International Financial Reporting Standards, LIFO is not allowed because it's an opportunity for abusive and or manipulation in terms of accounting numbers. And also because for most of the industries, the LIFO assumption doesn't make a lot of sense. Why do you want to use the newest inventory first before you use the oldest? Because the oldest could get expired or spoiled and become useless. So that's oftentimes counterintuitive to assume you have a LIFO inventory system. So I just explained under the rising unit cost situation, FIFO has the highest end inventory and the lowest cost of goods sold. LIFO has the lowest end inventory and highest cost of goods sold. And then if we have a situation that price is actually going down, then it will be just the opposite. FIFO has the smallest end inventory and highest cost of goods sold. LIFO has the largest end inventory and smallest cost of goods sold. So I just mentioned the impact of tax. There are other impacts. For example, we just mentioned the net income numbers are different. FIFO has the highest net income number because it has the highest income before income tax and also the highest tax expenses. LIFO on the opposite side. And another impact is the cash flow effect. That is, the amount we take in from customers will be the same. The amount we go out to pay our suppliers for the inventory is the same. But here, if we use FIFO, our tax outflow, especially to tax agencies, will be the highest. 45 versus 36. So the tax situation is also unfavorable to a firm who is using FIFO. We have a couple more. Actually, I think 2 topics left. I think I'm going to stop here and start my next talk or lecture with the last 2 topics.